Hello and welcome to a CMS Forex Daily Market Recap. I'm your market analyst, Nick Nassad. Today is Friday, June 4th, 2010. Let's begin by taking a look at the euro-dollar pair, which slid sharply overnight and then accelerated its losses in the New York session. There were renewed concerns over the Eurozone's sovereign debt situation, and investors worried about Hungary as it could be the next country infected by the crisis. A Hungarian government spokesman said that default talk was not an exaggeration and that Hungary would not go ahead and implement austerity measures. Hungary was in a grave situation because the previous government had, quote, manipulated and lied about the state of the economy. Hungary needed a 20 billion euro loan to avert a default in 2008, and it seems that the current financial situation in the Eurozone has it again at the brink of defaulting. Now, a default could mean that creditors holding Hungarian sovereign debt bonds would not get their full investment back, and that sent a very big wave of jitters throughout the Eurozone financial system. Many of those creditors are banks in Europe, and a default would hurt their balance sheets. And this is a similar situation that we had faced with Greece, though Hungary isn't part of the Eurozone and doesn't use the euro. It has its own currency, the forint. So what we saw today was a move to minimize exposure to the country's debt, and that had very heavy risk aversion in the currency market. The Hungarian situation sent bond spreads between Germany and other EU members higher, which pressured borrowing costs. The news also brought to the front the underlying dynamics in the recent environment in the past 5 months, and taking away the day-to-day swings, and it's one where the European financial system is coping with severe difficulties, which has had the euro on the back foot for the better part of this year. So in today's trading, we broke below the 1.21 area and actually moved below 1.20 for the first time since March of 2006. We had been monitoring that support level as it had been tested several times throughout the past weeks, though we did have descending triangles setting up recently as part of our consolidation in the pair. So we broke that formation to the downside, and it corresponded to about a 200 pip swing, or 250 pip swing from high to low overall. This break of support, of course, now opens up the euro to even further losses, though there may be some bit of a correction before that happens. The concerns floating around in the Eurozone financial system helped the Swiss Franc to strengthen as traders moved their money to the safety of the Switzerland banking system. And we saw the pair break first its overnight support at 1.4050, but then this very important 1.40 level, which had been defended by the Swiss National Bank earlier on in May, as we see here on May 6th, as well as here on May 20th. Now, this time there was no SMB intervention, and we broke below this level, hitting a low of 1.3864, which was actually a record low for this pair. If it continues to fall, say to open next week, investors will keep an eye out for a possible fresh round of SMB intervention in order to temper franc strength. Yen crosses moved sharply in favor of the yen in today's risk aversion trading. Here, take a quick look at the dollar-yen pair, and we see that following a test just below the 93 level, which was our resistance from back here on May 18th, we slid sharply in today's trading, cutting most of the gains we had seen throughout the week. We actually even moved below this next level of resistance turn support at the 91.60 level, though we trade right at that level prior to the close for the week. So far this is a 38.2% retracement of this move from May 26 up to our highs overnight. Similar story in our other yen crosses. Here we look at the pound yen, and we see that we slid below our support yesterday at 134.50 and repaired all the gains from midweek in this 3-session rally we had during the middle of the week. Commodity currency pairs also suffered or moved in favor of the greenback. Here we're looking at the Australian dollar, and we see that we had a very sharp decline from high to low, was amounted to about 250 pips, and we moved below our support for the week at the 0.8285 level. Our next level of support on the downside will be this 0.8070 area that we tested on May 25th. And we can see that we fall back into this bit of a consolidation, sideways consolidation zone if we put our resistance here up at 0.8515. That had been mainly focused on the effects coming over from the Eurozone situation, especially with Hungary, but we also did have the non-farm payroll release today from the US, which came in weaker than expected, which added to the sense of risk aversion during the New York session, so that extended some of the declines we had seen in some of these pairs. So the Aussie US dollar, for example, had set up at the 0.83 level, here at the 200 period moving average around 0.8380, but then following the non-farm payroll release, we slid further down. We also had pretty sharp losses in US equities, again adding to the sense of overall risk aversion in the financial markets. Taking a look at just the final market highlight, USD Canadian dollar, similar to the Aussie, we see our gains in favor of the Canadian dollar paired in today's session, and we broke above our resistance at 1.0550, which had been our previous high for this week. Here too, we move above our 200 period moving average, and we retrace now about 50% of our full downswing from this 1.085 area down to 1.0350. Now that we've seen our main market highlights, let's take a look at today's key fundamental release, the non-farm payroll report. The report showed that the U.S. economy added 431,000 jobs during the month, which was lower than the forecast of a 515,000 job increase. And it follows a 290,000 gain in April. So if we look at the chart of non-farm payroll change to the right, we see this trend first of decelerating job losses and now job gains for the last 5 months. However, the big number here, which was actually the biggest amount of job growth since 2000, was primarily fueled by a 411,000 increase of temporary workers for the U.S. Census. Therefore, we only saw 41,000 private sector jobs created during the month. The unemployment rate did ease down to 9.7% from 9.9% the previous month. The unemployment rate, which is deduced from the household survey, also showed that the civilian labor force decreased by 322,000 and the number of unemployed decreased by 287,000, so that lowered the unemployment rate to 9.7%. Looking at a breakdown of the figures, we see that here's a total 431,000 jobs gained, with only 41,000 coming from the private sector. Goods producing sector only added 4,000 jobs, as the increase in manufacturing and mining was offset by a sharp drop in construction, which wiped away the gains we had seen in the construction sector the previous 2 months. We see that a large amount of jobs in the private service providing sector was actually temporary help, continuing the pace of temp help we have seen, while financial activity services decreased 12,000, so a negative there. Also of note was leisure and hospitality, which had added 23,000 and 35,000 jobs the previous 2 months, only added 2,000 this month, which may be a result of the BP oil spill, which is showing up in that figure. And as we can see, government added 390,000 jobs, so we actually had 411,000 census jobs, so non-census jobs actually fell by a figure of about 30,000. So overall, despite the very large headline figure, this was a disappointing report. I'm showing that private sector job growth fell off compared to the last 2 months when we had 158,000 and 218,000 jobs created, and it will pose some questions about the U.S. recovery going forward. Traders in the U.S. reacted negatively to the news as well as to the financial troubles in the Eurozone, and the Dow Jones was off more than all the main indexes were off more than 3.2%, with the Dow Jones down more than 300 points, falling back below 10,000. So overall, we're heading into the weekend in a state of risk aversion and troubled over the financial markets, as well as the unexpectedly weak U.S. payroll data. And so with that, we will conclude our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you a good weekend.